Inflation is a critical economic factor that influences market trends and investor behavior. It refers to the general increase in prices of goods and services over time. When inflation rises, the purchasing power of money decreases. This dynamic is essential for retail investors to understand as it directly impacts investment decisions and portfolio performance. Understanding the causes of inflation is vital. There are two main types: demand pull inflation and cost push inflation. Demand pull inflation occurs when consumer demand surpasses supply. Conversely, cost push inflation arises when production costs increase, leading to higher prices for consumers. Both types can create volatility in the stock market. Rising inflation can lead to higher interest rates. Central banks, such as the Federal Reserve, often increase interest rates to combat inflation. Higher interest rates can lead to increased borrowing costs for companies. This situation can result in lower consumer spending and potentially decreased corporate profits, which can negatively affect stock prices. Besides affecting interest rates, inflation can impact various sectors of the economy differently. For instance, utility and consumer staple stocks tend to be more resilient during inflationary periods. These companies produce essential goods and services that consumers continue to buy regardless of rising prices. Conversely, discretionary sectors, like retail and travel, may suffer as consumers cut back on non-essential spending. Real assets often perform well during periods of inflation. Real estate and commodities, such as gold, typically retain their value and even increase during inflationary times. Incorporating these assets into a diversified portfolio can help investors hedge against inflation. This approach provides a buffer against the erosion of purchasing power. Investors should also consider inflation-protected securities. Treasury inflation-protected securities, TIPS, are designed to protect investors from inflation. The principal amount of TIPS increases with inflation, ensuring that returns keep pace with rising prices. Incorporating TIPS into a portfolio is another strategy to safeguard against inflation risk. Equity investors must closely monitor inflation data and its potential impact on earnings. Rising costs can squeeze profit margins for many companies. Corporations with strong pricing power can often pass these costs on to consumers. This ability is critical for maintaining profitability. Investors should assess a company's capacity to manage costs and sustain earnings in an inflationary environment. Portfolio rebalancing is another crucial step for investors facing rising inflation. Regularly reviewing asset allocation can ensure the portfolio remains aligned with long-term goals and risk tolerance. Certain sectors may become more favorable, while others may lag due to inflationary pressures. Adjusting allocations can help mitigate risk and take advantage of new opportunities. Understanding commodity cycles is essential for retail investors as well. Commodities often react to inflation with increased prices. Investing in commodity funds or ETFs can provide exposure to this asset class. Such investments can act as a hedge against inflation and can complement a traditional equity portfolio. Investors should stay informed about economic indicators that signal inflation trends. Key metrics include the Consumer Price Index, CPI, and Producer Price Index, PPI. These indicators provide insights into inflationary trends and can influence market sentiment. Monitoring these indicators can help investors make more informed decisions regarding asset allocation and timing. Additionally, investors should focus on quality stocks with strong fundamentals. Companies with solid balance sheets and a history of profitability are often better positioned to navigate inflationary pressures. These companies may have the flexibility to adjust pricing strategies, managing their profit margins effectively. Another strategy involves considering dividend-paying stocks. As inflation rises, companies that can consistently pay and increase dividends become attractive. Dividends provide income that can help offset the effects of inflation on purchasing power. Investing in companies with a track record of dividend growth can enhance portfolio resilience. Investors need to be cautious about market timing, especially during inflationary periods. Making impulsive decisions based on short-term market fluctuations can lead to suboptimal investment outcomes. A strategic, long-term approach is often more beneficial. Sticking to a well-researched investment plan can yield better results over time. Finally, engaging with financial advisors is a prudent course of action. Professional guidance can provide clarity and tailored strategies for navigating inflation-related challenges. Advisors can help in adjusting investment strategies based on individual risk tolerance and financial goals. Understanding inflation and its impact on investment portfolios is critical for retail investors. By recognizing the causes of inflation, staying informed about market trends, and employing strategic investment approaches, investors can safeguard their portfolios against inflationary pressures. Taking these steps can lead to more robust investment outcomes in a fluctuating economic landscape.